Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. Today, we're spotlighting a truly unique situation that has caught our attention due to its incredibly high cost to borrow. We're talking about a company whose short sellers are currently paying an annualized fee well over 500% to maintain their positions. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Today's deep dive is into IO3 Limited, trading under the ticker IOTR. Share IOTR logo/chart. This company, firmly planted in the communication services sector, specifically telecom services, is a small cap player with a market cap of just $18.03 million. IOTR provides critical maritime digital technologies, satellite connectivity, and digitalization solutions to the maritime industry, operating through its satellite connectivity solution and digitalization and other solutions segments. Zoom in on sector. Now let's talk about its recent performance. IOTR has seen some significant upward momentum. Today alone, the stock is up an impressive 6.50%. Looking at the broader picture, it's gained a massive 40.15% over the last 5 trading days, and a stunning 73.73% over the last 30 days. Volume today was 1,358,600 shares, which, while substantial, is actually about half or 0.5x its 30-day average volume of 2,530,943 shares. Show price chart with 1D, 5D, 30D performance highlighted. What is cost to borrow and why it matters? So, what exactly is the cost to borrow, or CTB, and why is it so crucial in identifying potential squeeze candidates? Simply put, the cost to borrow is the annualized fee that short sellers must pay to borrow shares of a stock before they can sell them. When you short a stock, you're betting its price will go down. But you don't own the shares, so you borrow them from someone else. That loan comes with an interest rate, the CTB. Show animation of short selling process. A high cost to borrow signals two main things: either there's a very high demand from short sellers to bet against the stock, or, more commonly in extreme cases like IOTR, there's a critically low supply of shares available to borrow. When fees exceed 100% annualized, like the situation we're seeing with IOTR, it means short sellers are essentially paying back more than the stock's value in fees every single year, just to maintain their bearish bet. That's an astronomical cost and a massive amount of pressure. Why this stock is hard to borrow right now. This brings us to why IOTR appeared on our hard-to-borrow screener. The numbers for IO3 are truly eye-opening. The current cost to borrow fee is a staggering 534.5% annualized. Show CTB number prominently. To put that into perspective, imagine paying over 5 times the stock's current price in interest every year just to keep your short position open. What's more, this isn't a static number. The CTB momentum for IOTR has increased by 69 percentage points over just the last 5 trading days. This rapid escalation tells us the supply-demand imbalance for borrowing shares is intensifying. Show CTB momentum chart, and here's perhaps the most critical data point. As of our last check, there were only 900 shares of IOTR currently available to borrow. When you consider IOTR's estimated float is 2.7 million shares, having only 900 shares available means less than 0.4% of its entire float is left for shorting. That is an incredibly tight supply. Our internal composite squeeze score, which combines factors like CTB level, momentum, borrow supply, and technical setup, currently registers IOTR at a 44.6 out of 100. This isn't a top-tier score, but it indicates several key factors are aligning. It's important to remember that a high cost to borrow does not guarantee a short squeeze. Sometimes, short sellers have extremely strong conviction in their bearish thesis and are willing to pay these exorbitant fees to stay short. Squeeze mechanics explained. So, what is a short squeeze, and how does a situation like IOTR's potentially set the stage for one? A short squeeze occurs when a stock's price starts to rise significantly, and short sellers, who were betting on the price falling, are forced to buy back shares to cover their positions. This forced buying creates even more upward pressure on the price, trapping more short sellers and creating a kind of domino effect. Show animation of short squeeze. The mechanics are simple. A rising stock price means short positions are losing money. A sky-high cost to borrow, like IOTR's 534.5%, adds an immense daily cost burden on top of those losses. When the supply of shares to borrow dwindles to almost nothing, like 900 shares for IOTR, it becomes nearly impossible for new short sellers to enter the market or for existing shorts to adjust their positions. Facing unlimited loss potential and rapidly escalating carrying costs, short sellers often have no choice but to stop buying back shares to close out their positions, driving the price even higher and accelerating the squeeze. Dilution risk check. Before getting too excited about squeeze potential, it's crucial to check for dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can severely negate or even completely offset a short squeeze thesis. Why? Because new shares flood the market, increasing the supply available for shorting, which can reduce the cost to borrow and alleviate the pressure on short sellers. It also dilutes the value of existing shares. In the case of IOTR, our checks found no recent diluted SEC filings such as -1s, -3s, or 424Bs in the last 90 days. This is good news, as it means there aren't immediate, obvious signs of new shares being issued that could flood the market and undermine any potential squeeze momentum. We also found no recent reverse splits for IOTR in our look-back window, another factor that can sometimes impact borrower dynamics. Once again, I want to reiterate our disclaimer. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For IOTR, given its current hard-to-borrow status, here's what we'd be watching closely. Firstly, continued increases in the already astronomical 534.5% cost to borrow fee would be a significant indicator. Highlight CTB. Secondly, any further reduction in the already scarce 900 shares available to borrow would intensify the pressure. Thirdly, watch for sustained high-volume price action. While it has seen impressive gains, today's volume of 1.35 million shares is below its 30-day average. A true squeeze often involves massive, sustained buying volume. Given its small market cap of $18.03 million, even relatively small buying pressure can have a large impact on share price. In summary, IO3 Limited did presents a fascinating case study in the hard-to-borrow market, with a colossal 534.5% cost to borrow fee, rapid CTB momentum, and an incredibly tight supply of only 900 shares available. While its recent price action has been strong, it's vital to understand that a high cost to borrow is a risk indicator for short sellers, not a guaranteed squeeze signal for buyers. As always, thorough due diligence and understanding the risks are paramount. If you found this analysis of IOTR insightful, please hit that like button, subscribe to the channel for more unique hard-to-borrow breakdowns, and let us know in the comments below what stocks you're watching and any questions you have. Thanks for watching, and we'll see you in the next video.